So when I was interviewing after graduating from Rutgers, or during my graduation from Rutgers, most of the interviews would ask, "Do I have somebody that I look up to?" And my answer was
Will
Will
Smith.
Smith, because he was sort of the triple threat. Like he was the actor, he was the singer, he was the comedian. He just had the good looks. Like he's got everything going for him.
Wow.
But now he's sort of taken a step down my ladder because that was certainly not appropriate.
Okay, so it wasn't the Scientology that did it. It was the slap of Chris
Oh, I
Rock.
wasn't wearing that.
Got it. Okay. Yeah. Okay. Yeah. That's enough. Will Smith is good. Did you see all the Men in Black films? By the way, cheers. Would you like some coffee? I'll bring it to you.
Good. Don't force it down.
Just for the audience and for the record, Brett Horowitz, how many times have you had coffee in your life? Does it make any sense?
Goose egg. I don't need coffee. I'm naturally wired. I wake up in the morning and I'm ready.
And why won't you have coffee? You never even entertain me by just having like a cup with me or a little shot.
No, I'm not a huge warm drink fan. Like, I mean, I can do like a cup of hot chocolate if I need to get by in like a cold place. But warm drinks, especially down here in South Florida, they seem weird to me. And the whole caffeine thing, I don't want to get hooked on caffeine. That's the biggest thing. I see what everybody else in the office does when the coffee machine's broken. It's like, we got a coffee machine. It's broken. Quick, fix it. And like, I don't want to get that way.
Okay. Who gets that way?
Lots of people do.
Really?
And the espresso machine and the coffee machine goes down. Woo.
Well, you don't go out for coffee much, but like when you're like with clients or with prospective clients, like you go grab a coffee. I don't like tea, and you're not going to be a weirdo and have a glass of water. So
Weirdo.
Oh my God, Brett Horowitz. Jeez.
But maybe I'll get like a smoothie, or maybe I'll get like a banana muffin or something. So at least it looks like I fit in there.
That's hilarious. Yeah. I'll have a cinnamon bun. Thanks.
There you go.
Welcome to Talk Your Chart, episode 15. My name is Marco Segrera, here with Brett Horowitz. Brett, let's get right into it. Today, I am kicking us off with the yield curve. The yield curve has been making headlines because it is close to inverting.
Yikes.
Yeah, all these super fancy, very understandable words. So everyone's freaking out over the yield curve because the yield curve is freaking out a bit. Why do people care about the yield curve? People care about the yield curve because many pundits will tell you that the yield curve is a leading economic indicator. It's actually one of the 10 components in the leading economic indicator index. And when a yield curve inverts, Brett Horowitz, we know that that many times signals that a recession could be coming down the pipe.
So to be clear, let's explain this to people. The yield curve is the different yields that different treasury maturities have, from
Yes, sir.
short term to intermediate term to long term, and they develop a curve that shows how those yields either increase or decrease based on the maturity of those fixed income investments.
Yes, sir, precisely. So that's why my first chart, which means I also have a second chart, but my first chart shows what normal curves look like, which is basically just what you said. Shorter maturities, less interest, longer maturities, more interest. As the curve flattens, that means the shorter rates start paying almost as much as the longer rates until an eventual inversion where your shorter start paying more than your longer, which is weird. That shouldn't work. What does that basically signal? It means as that flattening and then inversion happens, the market is saying we expect less economic growth in the future. So that's what's starting to happen now. It's a weird looking curve if you look at the one we have right now, but that's what we're looking at. Chart number 2, Brett Horowitz, is which ones along that yield curve should we compare? Well, again, back to the experts, so to speak, they would tell you to compare the 10-year treasury and the 2-year treasury. However, the quote unquote official yield curve or treasury spread to look at is the 10-year treasury minus the federal funds rate, which is what this chart that we are looking at is showing us. Specifically, the blue line is the 10-year minus that federal funds rate, so call that the official. And then the red line, the 10-year minus the 2-year. That black line would mean inversion. Brett, what pops off to me here real quick? How different that red line and that blue line are looking right now, where usually historically they're pretty in line, pretty tight.
Right. I mean, look, I think the bond investors are an odd beast because they're always trying to predict what the Fed's going to do. They're trying to predict what the economy is going to do. In normal times, you should expect a higher return for longer dated bonds because you're taking more risk. And so anytime you have this weird situation where you're getting a higher return for shorter bonds than longer term, it's like, whoa, what do they see that we don't see? But let's be clear, it's not that they can predict a recession, right? It's not that every time the yield curve goes negative, it means a recession is coming. It just means oftentimes it could mean one is coming.
Yeah, so I think you're right. I think obviously that this isn't a perfect predictor of a recession coming. For example, the last time the yield curve inverted, we did get a recession within 2 years after, but that recession was caused by COVID. We gave ourselves an intentional recession. But yes, the yield curve did invert, call it, I think that was 15 months before March 2020. Does that mean that the batting average is still as high because the yield curve inverted and then we put ourselves into a recession? Probably not. However, if you look historically at the other inversions of that official one, the 10-year and the federal funds rate, what I think based off what I read and the much smarter people than anyone on this Zoom, it looks like there's a correlation between what the Federal Reserve is doing, meaning what's happening to that federal funds rate, what they're doing interest rates generally, and credit crunches. And credit crunches, meaning lack of liquidity in markets, lack of ability to get a loan to either service additional debt or to keep kind of the business wheels turning, has to do with yield curve inversions, because that becomes less affordable as you get these rising interest rates. So I think it's perhaps more of a story of credit crunches as opposed to just a pure, is the yield curve inverting?
Yeah, but you and I have talked about this before, that if the federal funds rate goes from a quarter of a point up to potentially 2% by the end of the year, if the Fed continues with the 7 more interest rate hikes, that's still awfully low, right? I mean, it's not like you're talking about people not being able to get a house or being able to buy a car. You've still got interest rates that went from 100-year lows, to now 80-year lows or something still super low. And I also think that sometimes this tends to be self-fulfilling, where headlines scream, oh my gosh, inverted yield curve. Everyone then says, well, that means a recession. Then people start to think, well, a recession's coming. So let me start hoarding my money. Let me not spend as much because all professionals are saying a recession is coming.
I agree. Downstream impact of that exact statement. So what you just said, I wholly believe is true because I'm a big behavioral guy and I think behavior moves markets. Fingers crossed, because this could happen. Everyone's worried about the Fed raising rates. That will happen. But because of that psychology, because everyone feels a recession is coming, that should put downward pressure on global aggregate demand, at least definitely in the US. And hopefully that naturally reduces inflation over the next 12 to 24 months. Because obviously the predictions that we made about inflation 4 months ago, those are not going to be right. Again, we didn't predict the conflict in Russia, Ukraine, and obviously what that has done to further exacerbate the supply issues plus the energy issues, that just changes the game. And again, just shows the lack of utility in most predictions.
I think what this also tells me is that if you're a bond investor, the statistics are that being an active bond investor, someone that trades bonds, buys and sells different bonds, you can get a lot more value in doing that than on the stock side, because all this movement in interest rates is affecting the prices of bonds. And so you've got to really know, do I want to own short-term bonds, intermediate-term bonds, long-term bonds, high quality, low quality? What's going to happen to the economy, right? All these factors come into play with what return you get on your bonds. So I think that's why we hire a lot of active bond funds, and why most of the research has shown that they can provide value, or at least a better chance of providing value.
Yeah, look, man, the way we do it, we just need to make sure people pay back their debts. So credit rating, credit risk, that's what we care about. So anyways, look, if you ask me which yield curve am I going to pay attention to, I'm going to go ahead and stick with the quote unquote official one, which is part of that leading economic indicator index. And that's the 10 and the Fed funds. And the 10 and the Fed funds, not close to inverting. So I say we got plenty of runway for markets to move.
So you are not calling for a recession in the next 6 months?
No, I was last week. This week I'm not.
Yeah, crystal ball is always foggy, so
Yeah.
don't ask us about what's going to happen.
What do you have for us?
So I want to talk about a topic that is going to be on everyone's minds in about 2 weeks when this video comes out, which is tax day and the
Oh,
day that we both have an Uncle Sam to talk to.
all right.
And one of the most confusing topics that I end up talking with clients about, and you might get it as well, is client looks at their Schwab, Fidelity, TD Ameritrade statement, and they say, my gosh, I've got all these investments, usually bond funds, that are down. Like, how could you buy me all these bad bond funds that keep losing money? And the first thing we have to share with them is saying, look, these are not down in value. They're down from a tax standpoint, but performance-wise, they've actually made money. So I want to share a little example there on what it actually looks like.
Okay. We all get this question. This is a tough one. This is, if you don't get it, it's just hard because you're looking at numbers. And yes, the number says it's a loss. And then you have to come back and say the performance is different because your basis is getting higher. So it's a tough, yeah. Okay.
For sure. And so I want to share with folks to see maybe if other people have questions or they don't understand it, maybe it'll sink in, showing a little example here of a fund that was in a client's account. And so here we have a Thornburg fund that was bought in 2014, and the client paid, if you see in the cost basis column, $87,500 for their first purchase back in June of 14. And if you know anything about bond funds, you know that every month, not always, but most times they pay out income, right? Bonds produce income, they pay that income to the shareholders, and you get interest payments from that. Our clients have chosen to reinvest those income into more shares. So each month here, you can see there's an additional 9 shares or 12 shares or 13 shares, and that is giving them additional quantity of this bond. So we fast forward now at the end of 18 or beginning of 18, been almost 4 years, and we look now and we look at the total line. That client now has a cost basis of $96,700, and they have a value of $94,300. So the client's going to look at their custodian statement and say, I've got a loss of $2,000. And that's why they look at it from a price standpoint. They say, I lost money over this period of time.
Yeah. So how do you get them to focus on the right thing?
Well, it is true that if they were to sell this fund today, they would be able to realize a $2,400 loss. So this is beneficial to them, and that they can take that loss and offset other gains or use it to offset income. But what I would do is I would compare the initial cost basis, what you purchased that fund for, $87,500, compare that to the current value of $94,300, and say, no, you actually made 7% over this period of time. Yeah. The reason is because every single time you earned a dividend, that increased your cost basis. It increased your tax, but basically you got all that money throughout all those years from income along the way.
Yep. And I wish statements or tax documents somehow conveyed that, because yeah, we do get this question pretty often. And it's just the math. It's tough.
Well, but on our portal, and whenever we show clients reports, the true performance number, which takes into account the price and also the income, will show the 7.8 figure. So we do show the actual performance. And to the clients, I tell them this is sort of the best of both worlds. You made 7.8% on this bond, and if you sold it, you actually get a tax loss.
Sure.
So it's almost similar to the rule that if you have a house, you get an extra exclusion when you sell a house on a capital gain. So if you have a house that went from $500,000 to $700,000, you don't pay any tax on that because of a capital gain exclusion. Doesn't mean your house didn't go up in value.
I use that comparison as well. It's the same as installing air conditioners at your home, and you kind of increase your basis because they're wondering, I didn't invest anymore, but you did because you reinvested your dividend and all that type of stuff. So your basis goes up. So ultimately it's confusing, but at the end of the day, you end up making the return that you have if you look at your proper starting point compared to where you are now.
Yeah, and I will also add that each time here that you're getting this income payment, this is basically the bonds that you are holding paying you back their own income, and this is not free money in effect, which we're going to cover in a future episode. I'll leave a teaser there.
Sounds like you're bringing up the dividend conversation, Brett Horowitz.
Yep, bond funds and stock funds that pay dividends is another topic that no one seems to understand. So I've got another series of talks next week to talk about.
I want to live off my dividend, my high-paying dividend stocks, Brett.
You
That's what
mean
I want.
the free money, right?
Yes, that's what I want.
We should all buy dividend stocks and income paying bonds the day before they pay out that income and dividend because it's free
Dude,
money.
I just want to own Coca-Cola. High dividend stock, baby. Let's go.
Well, I'm going to throw some more cold water on that idea next time.
How weird, Brett, throwing cold water. I can't wait.
This is all about informing our clients what they need to know. And bonds are certainly one of the more difficult and challenging conversations to have because of the fact of interest rates, because of yield curves, because of duration, because of all these different things affect the price and the performance of bonds.
I hear you. Well, I look forward to next time, Brett Horowitz.
Okay, let's do it. Have a good one.
Talk soon, baby. See ya.